So first, you might have wondered why I brought 3 potatoes with me. So it could be because I used to live in Idaho, and 3 potatoes is very lucky if you take them. But actually, it's for a game we're going to play. This is going to be your second reference to hot potato since lunch. I did not see that one coming. So who here knows the game of hot potato? A few. Okay, so the general idea of hot potato is you don't want to be holding on to the potatoes, but you need to hold them because I gave them to you. So the way you play hot potato is you need to pass them on. If you're still holding it when the game ends, you lose. But this one's a little different. This is a version I call modern banking. Those potatoes are actually reserves. You don't want to hold them any longer than you need to because, well, you're paying maybe depositors' interest on those. You're paying FDIC insurance premiums, and you're not making any money while you're holding them. So you got to get rid of them quick. So the whole idea is to get rid of them. So how are we doing here? So you can either get rid of them by loaning them to a consumer who banks somewhere else, because that'll move those reserves over there when that's settled, or you can loan them on the interbank market, give them to another bank that way. But you guys are really bad at this game because there's only 3 potatoes. The whole point's to not hold potatoes, and I still see people holding 3 potatoes. This is pretty disappointing. So we can just stop. We don't need to play this game anymore. Kind of disappointed here, but. So my first point here, so individually, banks do lend reserves. I know that hard to get across to an MMT audience like just yesterday. Repeat after me, banks cannot and do not lend out reserves. So I'm saying banks do lend reserves. I did clarify this with Paul. We are on the same page here. Turns out lend out reserves has a lot of meaning on that out. It really needs to be underlined there. So first, banks do lend reserves. Say if a borrower gets a mortgage from Wells Fargo and buys a house from somebody that banks at Citibank, when that mortgage closes, that money, those reserves do go from Wells Fargo over to Citibank. But then there's also the interbank market. So maybe now, after that mortgage, maybe you got a really nice house, Wells Fargo's a little short on reserves, so then they'll borrow some on the interbank market from Citibank. Either way, those reserves are moving around. But just like the potatoes, you can move it around, but it doesn't disappear. And that's really what Paul's focused on. This lending, it doesn't consume the reserves. They still stay out there. So that's how, what I said actually is true, even after his title. They do not lend out reserves. So that's why, so the point there is, absent that intervention, what would happen? Excess reserves would drive interbank rates to zero. All this lending, interbank lending, consumer loans, those reserves are still in the system unless people take it out as cash or unless it's taxed out of the system. So that's why, if the Fed doesn't take those excess reserves out, it just drives the reserves to zero. So that's one of the reasons why we borrow. So that raises an interesting point, which I think is very true, but very few people would acknowledge, is that the primary purpose of interest on the national debt is to maintain interest rates in excess of zero. Who here thinks that's true? Who here thinks it's false? True? I need to see a hand, one or the other. True. False? I got one false there. I think it's true. We'll see if I convince you. So if that's the primary purpose, so do interest rates matter? Are interest rates essential or useful as monetary policy? What are the implications of paying that interest on the national debt? What are the pros and cons of that? And would it work to just leave nominal rates at zero, which is something that most MMT economists propose? So first, rates as a monetary policy tool. So again, I'm going to do the unpopular in this crowd and make the case for rates as a monetary policy tool. So first, the asset price channel does have a lot of power to it. When yields rise, values fall. We all know this on affordability for homes. When mortgage rates rise, you can afford less homes, so, home prices suffer. Investments. So just for simple math, let's assume we have a perpetual bond that pays $1,000 a year. Rates are currently 5%. What's that bond worth? Somebody's good at math here, right? Somebody? 20 grand. 20 grand. What if we drop rates to 1%? Then that same bond is worth 100 grand. So 5x, that's pretty good, right? So when when yields fall, the value of assets rises. That makes people feel wealthy. Now that your house is worth twice as much, or we just made 80 grand on that bond that just went up. People feel wealthy, so they go out and spend. Likewise, those asset values also directly impact commodity and labor. When housing prices go up, well, the price for drywall goes up, the price for lumber goes up, the price for labor goes up. So these things do spill through to the economy, especially in the short term. Also, in markets like Australia, where there's a lot of adjustable rate mortgages, there's also a lot of quick pass-through from those rate changes. When they raise interest rates, mortgage payments go up. That really sucks a lot of spending power out of the economy. And so there are some ways that rates work. But there's also a lot of ways where rates don't work, or like, you turn the steering wheel this way and like one wheel goes that way, one wheel goes this way, I think is kind of an apt analogy. So they don't work real well. So first there's the interest income channel. So Warren's written on that. So especially as debt rolls over time, it's basically fiscal stimulus. So we're trying to do monetary tightening, and so we pair that with a nice heavy dose of fiscal stimulus that, can last for 10 years or 30 years based on the duration of the bonds. So that's not great. Also, all this reduced investment, when asset values were falling, we said, hey, we're going to stop investing in those new businesses. It doesn't make sense to build that factory. The rates are too high. It just doesn't pencil. In the short term, yeah, that does reduce pressure. Not building that factory, that helps. But over time, well, now that you didn't build that factory, now whatever that factory is producing, there's a lot more price pressure on that. Same for restaurants. If rates are high, maybe it doesn't make sense to open that second facility. And so, what do you do instead? You raise prices. And then finally, like financing as a cost component. If you do still build that factory, well, you need to make sure you're getting your dollar per widget in interest out of that price too. So then you're charging $1 more per widget. So there's some ways it works, some ways it doesn't work. So I think sometimes we just kind of disregard it maybe too much in the MMT community, but I think it definitely has its flaws. I think, so what are the other ways we could do this? So outside of monetary policy. So first, we could do a job guarantee, like pretty obvious one there, right? Paulina's in the back there, like, let's do the job guarantee. That way, when the economy gets hot, well, two ways it works. So one, it's an anchor, $15 an hour, that's a nice anchor for the currency. Two, when things get hot, people leave the job currency to the job program because they can get jobs elsewhere. And then, fiscal spending goes down, so it works really well. Another, progressive taxation. When incomes rise, then people pay more in tax. That's especially true if the brackets are fixed or if the brackets are indexed to targeted inflation, not actual inflation. On that topic, I think we do a lot more to index inflation by the index things by the inflation we actually want, not the inflation we actually see. So we take stuff, every time we index things by inflation, we just are furthering that inflation. So if we say, hey, because of inflation, Medicare is going to go up by 2%, Social Security is going to go up by 2%, all these other things, if we follow, that just perpetuates it. Whereas if we lead with that, we can use it as an anchor, just set it to where we want the inflation to go. Industrial policy, let's figure out those bottlenecks and actually address them. And then price stabilization systems. So I didn't put price controls up here. I'm not a huge fan of price controls personally. I don't think they really solve the problem. But there's a ton we can do on the price stabilization front. Things like buffer stocks, things like, on oil, yeah, we have the strategic reserve, but it's not that big. There's so much more we could have done when it was cheap to really, make sure we're bringing production online, but paying them not to produce it right then. There's so much we could have do to smooth that out. Likewise, copper, Joe Weisenthal, for those that listen to Odd Lots, he made a pretty good case for copper going up. Again, inflationary pressure, but there's no reason we can't have a massive stockpile of copper. It's just copper. You can fit a lot of that in a warehouse. So I think there's a lot of merit for the government to be focused on price stabilization systems to really prevent those commodity shocks from driving inflation. There's also some reactive things we can do. Reactive, I think, is definitely harder on this list. I think, if we, it's kind of the last guy's fault when you have inflation. But there are some things on the reactive side. So there's tax increases, there's spending cuts. You can convince people to save more. And there's credit controls. So there are some options. So if we don't need rates as a monetary policy, should we just leave them at zero? Who thinks we should? That's not very exciting for an MMT crowd. You guys are so timid. Okay, I don't think we should, but we'll get there. Most people think we should. The back row, I think, does. So some benefits to zero rates. So first, it avoids the inflationary bias of higher rates. We're not baking in that financing component to our prices. We're making the investments in increased capacity. So over time, it avoids that inflationary bias. It supports long-term investments like clean energy and energy efficiency. That's great in its own right, and it's also great from a disinflationary perspective. It avoids interest on the national debt, which increases fiscal space. If we went out and spent $1 trillion in interest, those people are going to re-spend that money. And even though we can always come up with the money, it's still going to create competing demand for the goods that could otherwise be available for the public benefit. And it avoids inefficiencies. If we just leave it at zero, like we have this housing market, where every time the economy gets too hot, we say, let's raise interest rates a lot. Let's make housing spike in cost, and then people stop building it. And then we wonder why it's expensive when we basically crush the entire industry like every 5 or 10 years. So maybe this boom bust cycle, maybe not the best way to run one of the most important parts of our economy. But I do have personally, so this is more my personal list here. So I do have some long-term concerns on ZIRP. So first is, if we have short-term zero rates, long-term rates are probably also going to approach zero as well. I think that's rarely discussed, but it's hard for me to see a mechanism where long-term rates would still stay high if we're saying, hey, rates are zero permanently. The main reason why long-term rates are normally higher, well, there's interest rate risk. It's low today, but it might go up, and so I want to be paid for that risk. Well, ZIRP, by definition, we're saying, hey, it's going to be zero forever. So at that point, there is no interest rate risk. So you don't need to bake it in, so long-term rates become, approach short-term rates. Likewise, liquidity, but again, in a place with zero ZIRP, you're not going to have any liquidity constraints. So you'll always be able to sell that long-term debt and get that liquidity as needed. So I do think that long-term rates would converge to short-term rates there. Also, if we're at zero nominal, that means we're at about, assuming 2% inflation, that means we're at about negative 2% real. And I think that can raise some concerns as to, asset values. What's something worth? So we did the prior example where none of you volunteered the math on the perpetual bond worth $1,000, $1,000 perpetual bond. How much is it worth? 1%, 100 grand. How much is it worth at 0% yields? Who knows? This one, I don't know. Like, I'm not, infinity? Another Toy Story reference. Infinity and beyond, I think, is what a $1,000 perpetual bond is worth if you approach a zero yield or go below. So that, this is the investor in me. Like, how's that going to work long term? So I have some questions there. The negative real rates can also encourage indebtedness, Ponzi finance. If I can go out there and borrow money at, if I can borrow money at 50 basis points and there's 2% inflation, why not go out and buy a basket of goods and just hoard it? I can refinance it next year. It seems like a pretty good business model. So some stuff like that, starts to make sense at permanent negative rates. And another downside, if asset prices do become inflated by those negative real rates, it could create a vicious cycle. So if you have, if you have 10% inflation, now real rates are 10%. Now that plan of hoarding a bunch of stuff, going out there and getting low interest debt to hoard a bunch of stuff, now it's really starting to resonate with me. So, yeah, so something to be wary of there. But as a caution, we did have the other list of stuff we can do. But so other options. So maybe zero rate. I don't know. There's some pros, some cons. What about a positive rate? So two benefits. One is it restrains asset prices and it discourages Ponzi finance. But there's also a lot of concerns on this one as well. So positive real rates, they increase inequality as risk-free savings compounds in real terms. So of all the inequality things, the one that I have the biggest problem with is the idea that money should just beget more money. The fact that if you start with $1 billion, you should end with $2 billion, even after paying for everything in your whole life, that's kind of disgusting. And when you have positive real rates, that just makes it that much easier. Another aspect is that positive real rates, as we discussed, can further inflation. There's the interest income channel, there's financing cost component, there's decreased investment. Additionally, government interest payments, they can reduce the fiscal space. If we're paying out a ton of interest, that's, again, driving more consumer spending, which competes with the government's ability to spend. And with positive real rates, government debt does compound over time. If the rate's higher than inflation, the debt will grow in real terms. And if the rate's higher than GDP growth, then deficits become unsustainable. So positive real rates definitely have some risk too. So another option, this is closer to what I'm pushing for. This is my own personal agenda here, not core MMT, but you're here to think, so think. So a zero real rate as opposed to a zero nominal rate, so kind of adjusting for inflation. So some things I like about this is it supports productive investment, but it doesn't support Ponzi finance or debt-fueled hoarding. So it's kind of a good balance. If the thing pays for itself long-term, it makes sense, but you can't just do financial arbitrage to make something that doesn't make sense. Additionally, budget deficits are still very sustainable, absent a rapid decline in GDP, but that's always kind of the case. If you capitalize the interest, plus every time you do pay that interest, you're getting income tax on that, assuming it's being paid to a taxpayer. And the real GDP growth continues to decrease jet to GDP. So even though you're paying interest in this scenario, not really a problem. So still some concerns with a zero real rate. One is that those interest payments do reduce fiscal space as compared to ZIRP, so that's a real downside. Bigger problem though, it could be very excessive during inflationary spikes. I am definitely not arguing that rates should be 6% today or 7% today. That seems definitely problematic. That would totally crush the housing market. Every time we change the rates like that, it creates those inefficiencies, that boom and bust cycle. And which index are we even basing this off? PCI, PCE, CPI? So there's definitely questions there. So now we finally get to what I'm pitching. Again, this is my own personal sales pitch, which would be a nominal rate equal to the inflation target. So rather than moving it around, breaking the economy every 5 years just to use it as a tool to crush the economy, let's just have a rate high enough that, over time we expect real rates to be around zero. So if we say, so if we're aiming for 2% inflation, if that's the central bank's goal, let's just set the nominal rate to 2%, and that way it comes out as a wash, 0% real. And then go back to those fiscal automatic stabilizers and really rely on them for price stability. Some pros to this: it maintains most of the benefits of the zero real rate, but it doesn't have those excessive changes with that boom-bust cycle. And even when negative, zero rates will be the long-term expectation, so they won't have the strong impacts on asset values that you might have otherwise if people expected negative rates permanently. So the one concern with this there still would be potential for a vicious cycle associated with unmitigated inflation. But maybe that's not the problem of rates to solve, is my view, and I think probably for most of you here. So who likes this one? Did I win anyone over? Oh, I got one, two. I got a few. Nice, nice. Cool. So if we want this rate, a nominal rate over zero, or a real rate of zero, or anything above zero nominal, we have to make it happen. There's that paper by Forstater and Warren on, the natural rate of interest is zero or something like that. And that's because, we already covered that. So how are we gonna bring that rate up? So first, one way is we ensure scarce reserves. We make it so there's not enough reserves to go around, so the price gets bid up. So a few ways to do that. We could do Treasury sales as a reserve drain, or we can increase reserve requirements. The other way to accomplish this is to establish a floor on bank lending. That's really what they do with interest on reserve balances. Overnight reverse repos kind of bridges the gap between the two. And also a new concept on pitching, an unreserved deposit tax, would get us to the same place. So this is monetary policy in the US pre-2008. Monetary policy with limited reserves. So basically, all they're trying to do here is balance the supply and demand so the rate is exactly where they want it. So if the rate's a little above their target, well then they need to introduce more reserves into the system. How do they introduce more reserves? They either lower reserve requirements, which makes less of a need out there, or more likely through open market operations, they buy up some treasuries, which puts more reserves back in the market. And so that way the price of those reserves goes right back down to where they want it. Likewise, if it's the price is pushing too high, then they just soak up some. Yeah, I got all of us backwards on this. You get my point, though. So under this approach, anytime more debt's issued, more interest needs to be paid just to keep the rates where we need it. So, moving on to the next one, this is post-2008, monetary policy with ample reserves. So back in the financial crisis, they wanted to flood the system with liquidity. Interbank lending doesn't work real well when, banks are going bankrupt and people are scared. And it's also to me, it's actually amazing that prior system ever even worked when you're trying to balance the supply on a daily basis so the price is right where you want it. Maybe guidance helps there, but this does seem like a very effective way to set rates. What they're doing in ample reserves is they're just saying, hey, we're going to have plentiful reserves out there. We're going to have way more reserves than we need in the system. We're going to flood it with reserves. So that would push the rate to zero, but instead of letting it go to zero, we're going to pay people interest on reserve balances to keep it above zero. So right now, the Fed says, hey, bank, if you just keep reserves rather than loaning them out, we'll pay you 90 basis points on that. And so that's a pretty good anchor for rates. If you're a bank, why would you loan money for less than 90 basis points if you can get 90 basis points with no risk just leaving it in your bank account at the Fed? So it works pretty well. There's also the overnight reverse repurchase agreements, which is basically just a way to extend this rate to people who aren't able to participate in the interest on reserve balances. So GSEs like Fannie Mae and Freddie Mac, primary dealers, and I think there's one other category. So there's a few people that just can't get the interest on reserve balances. So they also do the reverse repos just as a way to really borrow money and establish that rate from those as well.
Money market funds?
Yeah, that's the third one, yeah. Yep. So now we're going to move to a question. Got a problem to solve here. Congress is spending like crazy. Luckily, we have an independent central bank, right? Central bankers, how can we stop this? What can we do?
Raise rates.
What else can we do? That's just going to cause us to spend more money. How can we stop them from spending, right? Isn't that the whole point? We don't want to monetize this debt they're doing. Nothing?
They can't.
Exactly. They can't. So for all the talk of central bank independence, the only thing they can do is raise rates, which would make the government spend even more money. So this whole concept of oh, we're really going to teach you. It's like Who ever heard of like that guy who like saw his kids smoking and the kid's like smoking a cigarette, so the dad's like, I'm gonna teach you not to smoke, and he shoves all like 20 cigarettes, I don't even know how many in a pack, in the kid's mouth, makes him smoke them all at once. It kind of seems a little like that. Like, wait, so there's a fiscal imbalance, and so we're gonna make that fiscal imbalance worse and maybe crush the economy is our solution for, that's how we keep you behaving on the fiscal side. So like, yeah.
To fight inflation.
What was that?
That's what we do to fight inflation.
Yeah, that's what we do. I mean, does it work? Yeah, I don't know about that style of parenting. Maybe you, but not me. So, yeah, as we already covered, yeah, I think there's nothing new here. So the real only thing that, central banks, if they want to maintain rates, they have to monetize some of the debt for the demand. They just have to meet the demand. Like normal operations, they're buying assets and introducing currency to keep rates where they want them. If the government spends more, they still have to, buy assets and introduce currency to keep those rates where they want them. There's no way they can just like refuse to let the government borrow more. Yeah, they just have that sole stick of being able to raise rates, which if you're concerned about fiscal imbalance, seems like a really odd tool. So now I want to jump over to some opportunities to improve monetary policy. Again, these are from my perspective, so you have open minds hopefully, so you're just thinking, again, not pure MMT, but wanted to put it out there. So getting our money's worth on Treasury sales, maintaining rates through taxes rather than subsidies, increasing required reserves, or narrow banking. So first on more bang for our buck on Treasury sales. So first, government debt has become incredibly money-like. It's marketable or it's redeemable depending on the type of the bond. Liquidity for marketable debt is basically backed by the Fed, and it's postable as collateral. So even if you don't want to sell it at that point, you can still, borrow against it. Like nobody's ever been like, I really wanted to buy that, but all my money is like locked up in treasuries. Like, do corporations and wealthy person, So it's not taking any purchasing power out of the economy. Yeah, it's really just about rate maintenance. But there are ways we could make debt so it actually was better at taking purchasing power out of the economy. So we could reduce the money-like nature of those interest-bearing treasuries. We could say, hey, they're not marketable, they're not transferable, they're not redeemable, they're not postable as collateral. Basically, we'll put your name in a spreadsheet, and 30 years from now, we'll give you a check that includes the capitalized interest. If we did that, they'd be a lot more disinflationary. So if we are going to do bonds, if we do want to maintain rates, I think there's ways where we could just get a lot more bang for our buck out of it. So. Another is that we could capitalize the interest. So right now, we raise interest payments. There's more interest going straight into the economy. If we just capitalized it, if it was like all tips, then that increased spending power isn't coming to us in the short term. It's locked up long term. So if you combine those two things, you'll get a lot more for your debt. So of course, that's only if you think we actually need a positive interest rate, not a zero interest rate. So yeah, but there's more we could do there. Another one, setting rates. Right now we set rates by paying interest, right? Hey, we don't want you to loan below 90 basis points on the interbank market, so we'll pay you 90 basis points, just leave it there. You could do the same thing by charging banks for loaning money. So instead of saying, hey bank, if you lend out that money, we're going to charge you 90 basis points when you lend it. Just kind of reverse it. Just kind of like, you can do a carbon tax or you can do a carbon credit. Like either one works. So here's how that could look. So here's just a sample balance sheet of a bank. So this bank has $200 in reserves and $800 in deposits. So right now under current framework, interest on reserve balances, it's not 90 basis points right now, but let's assume the Fed funds rate is 2%. So they have 200 in reserves, so they get paid for leaving those reserves there. They get paid $4 a year at that reserve rate. So if we were to switch instead to taxing them when they loaned it out, so instead of saying, hey, we're going to give you $4 to not loan out those $200, we're going to say, hey, you had 800 in deposits, but only 200 is reserved, so we're actually going to charge you 2% on that gap, 800 minus 200. So then the bank would have to pay $12. Either way, the bank doesn't want to loan out any more money below 2% because it costs them 2%. One, they're giving up interest on reserve balances. On the other approach, they have to pay an additional tax. So it kind of gets to the same point without paying people who already have money for their money. So if we are going to have a positive rate, I think we should think about things like this to, again, how can we do it more efficiently? So some stuff I love about an unreserved deposit tax. So first, it's a really easy transition. In the next rate hike, the central bank, the FOMC, could just say, hey, we're going to do a 50 basis point rate hike in the target, and we're going to do that by having a 25 basis point increase in the interest on reserve balances. And we're also going to do a 25 basis point increase in the unreserved deposit tax. And so now the net cost of loaning out money to a bank becomes 50 basis points. But this is such an easy way to slip it in. You know, it's not like, hey, we have to abandon the old to get to the new. So I love just the low risk nature of it. So the biggest impact, you're like, what's the catch? How do we do that? Like, who pays here? And the person who pays is those who currently get interest on bank accounts. You know, it would reduce the value of deposits. That's where, you know, the free lunch comes from. And so that is a big change for the banking area to make this switch. That's one reason why you could do it gradually. Also, I think there's a ton of merit to subsidizing banking if we're going to do that in much better ways. Right now, that's why, you know, the banks are all where the rich people are, because, you know, if somebody keeps 100 grand in their checking account, get 0 interest on that, that's a really good client. The person who keeps 50 bucks in their checking account, you know, if you're trying to make like 80 basis points on that, that's kind of a tough business to be in. So if we want to subsidize it, there's so much better ways to subsidize it than the way we do today. Another cool part about an unreserved deposit tax is it would support articulated rates. You could give an exemption for lending for education, sustainable energy, affordable housing. So you could have different rates for financial leverage versus things that actually accomplish something. But then the another catch, I guess, on unreserved deposit tax is you would need to constrain shadow banking. So right now, we don't really need to worry about shadow banking because we're paying people to not loan it. You know, like why bother circumventing the system when we're basically paying you not to loan it out? When you're paying people not to loan money out, you don't need to worry about shadow banking so much, not for this purpose. But if you're charging people when they do, then you need to make sure that they're not working around it, that there's not an end run. So some benefits of that, of an unreserved deposit tax. So first, there'd be reduced interest payments. So you could either repurchase treasuries, you don't have to pay interest on reserve balances anymore. So there'd be a lot of fiscal savings there. I know we can always come up for the money with that, but I think back to the earlier point, if we're spending less on interest, you know, that's less aggregate demand on stuff we don't need, and we can direct that towards stuff we do need. Also, like I don't care about pay-fors, but this is a $5 trillion pay-for. So if you just run the math of not paying interest on reserves over 10 years on $4 trillion in reserves, if instead you tax unreserved deposits at 2%, and then you say, hey, maybe we can make it even better by, we're going to repurchase more treasuries, and so instead of just saving the 2%, you're going to save the 3.2% that we're currently paying on the treasuries. You know, you could pay for something with that, not that that matters. Another approach that I think, you know, I'd love to see more people thinking about in conjunction with MMT is increased reserves or narrow banking. So, you know, there's two ways to keep people from, you know, so if we jump way back to the other slides, you know, we could just increase reserve requirements instead of paying interest on reserve balances. So we're saying, hey, we're not going to make you hold any reserves, and we're going to pay you interest on all of your reserves. We could just say, hey, you need to keep 10% or 20% or 100% reserves, and we're not going to pay you any interest on that. That would come at the bank's expense, you know, but it's something we could easily do. Like, I think it's a really big and a really odd subsidy as rates increase to not rely on reserves and just to rely on interest on reserve balances. So I think that's another thing we could consider. The fiscal impact ends up becoming quite similar to UDT. So we would need to avoid shadow banking if we're trying to do credit controls or UDT or narrow banking or something like that to still maintain an interest rate but pay less interest. Shadow banking is a concern. Like as an example, a bank could offer, hey, what if we just sweep your money over to a money market fund every night? The money market can lend, you know, we can sweep it. You're getting 0 in your bank account, so we'll sweep it over at 50 basis points. We'll loan it out at, you know, 1%. You know, the bank's making money, everybody's making money. And it basically circumvents the unreserved deposit tax or credit controls, things like that. So you would need to address that if you were to go down this path. So a few ways to do that. First, regulations. Ban automatic sweep, like I just suggested. Ban dollar pegs. That's really banking. If somebody's saying, hey, it's always worth $1. You could do a tax on non-bank lending, you know, level the playing field. You could do a financial transaction tax. I actually personally love the pairing of UDT with a financial transaction tax, where you can say, yeah, you can move money over into a money market fund whenever you want, but we're going to charge you 0.5% on the way out and 0.5% on the way in. So people aren't going to use their short-term liquidity for it. So it's a pretty simple way to prevent the short circuit there. So that's I took all of half an hour there. That was supposed to be like an hour and a half, but I talk fast when I get excited, so working on it. So this is bonus section now. So I know what I just spoke about was very focused on the U.S., how the U.S. system works, and I know that's not representative of a lot of people in this room. So I wanted to build it out to, you know, what's this mean for people that aren't here? So first, speaking to the interest rate trap. So this is pretty common, like, hey, our currency is currently weak and we want to strengthen it. What should we do? I know, we should raise rates. That'll get people to keep their money here, it'll attract inflows, that'll keep our currency strong. But then we're paying more in debt service, Hey, we raised it from 5 to 10 to 20, but now we're paying out a ton in debt service. And unless that's all set by taxes, it's diluting the currency. If people are taking those profits and converting them back to their home currency so they can spend it somewhere else, again, that's just furthering that FX weakness. So there's a trap here that a lot of countries are in. And it's really just not a great solution of paying higher rates to keep your currency strong. So this is just kind of like a brain dump of stuff I thought of this morning, just in thinking on like what other options might make more sense rather than raising rates if you are in a developing economy. So the first, this is obvious for anyone who's ever heard Fidel talk, food and energy sovereignty. If you get that right, you really reduce the inflationary pass-through of a weak currency. The stuff I just talked about in this deck, reducing interest paid on government deposits, improving the disinflationary aspects of bond issuances, that stuff makes a lot of sense for developing economies as well. Reducing inequality, easier said than done, but the wealthy in developing nations, they love to spend all those hard-earned foreign money, just keeping it as foreign money, buying things abroad, which does not give you the technology you need, the medicine you need, or any of the things that actually help you move forward. Currency controls, it's not something I know much about, but have a lot of merit here for that same thing to keep that flight from happening. And then land banking. I missed this morning's sessions, but I know they talked on that a little. Super interesting, I think, from just the way it works, where introducing money by lending against stuff, I think if you look at what the Pennsylvania currency did and the like, I think it just has a ton of merit to developing nations. So this is just a very short list from somebody who knows nothing about the field, so hopefully you guys can add to it. Yeah, that's all I had, so.
Would you be willing to go back to one of your first con lists?
Which one?
Your first pro-con list?
This one?
Yes. The
Yeah.
first concern, long-term nominal rates would also approach zero. That's a concern. Can you explain why that's a concern for long-term nominal rates to approach zero?
Well, I guess it's no more of a concern than, well, on the long term, I think first are you questioning would they also approach it, or why that's a concern?
You're saying a concern
Yeah.
that long-term nominal rates would also approach zero. Why? So that implies that nominal rates approaching zero is a bad thing. Why is that a bad thing?
Because then real rates long-term would be negative, and I do worry about the distortions coming from that. So this is just my personal view, but I think it's something that is a weakness of MMT to an extent, where I think we often just discount it a little too easily. So I think when you there's a lot of crap out there on MMT, like, oh, it's, the Pelly stuff and the like, but like if you look at Mancu's analysis of it, it really comes back to his thinking that, hey, a 0% rate's not sustainable. And if we just kind of take it on faith often, and I'm not saying it's not sustainable, I'm just saying it might not be sustainable, and if our whole case is based on the fact that, hey, 0% will work just fine, we should be really prepared to defend that.
So am I correct that you're saying that it's not the fact that it approaches zero is a problem, but it's the potential for it to go negative that might be a problem?
Exactly, yeah. So it's the negative real rates where you can start doing, just the encouragement of Ponzi finance. That, if you know that rates are, because I think, so one thing I think is really important is just the differentiation between temporary negative rates, which we've all had and nothing bad happened, and permanent negative rates. If you can borrow money at negative rates for 2 years, but then rates are going to go right back up, or you think they're going to go right back up, that doesn't really make a difference. That perpetual bond is worth 101,000 instead of 100,000. But if you know if you have good reason to expect because of ZIRP that rates are going to be negative in perpetuity, then asset values, it's just really hard to figure out what something's worth, and the prices go really high there. So I think that's kind of what I'm addressing there.
Hi, yeah, thanks so much for the presentation. It was just a ton of information. So I was wondering if you could maybe clarify a little bit, like the theories that are sort of informing, some of your concerns, some of your analysis. In particular, what I'm interested in is, inflation is such a complex phenomenon, right?
Mm-hmm.
And you had some things in there where you're saying, okay, we have, real constraints. Then what I really like, you were also highlighting, okay, there's a concern when, investors see profit rates as too low, there is too little investment, which then later causes a real constraint
Mhm.
in terms of, not like a full-employment labor constraint, but a like, capital accumulation, investment constraint, which leads to inflation. So these are all sort of like, looking at sort of, effect of, certain profit rates, et cetera, et cetera. But then you talk about narrow banking.
Mhm.
And so I'm confused because I'm thinking, but we're talking about endogenous money, right? And like, sort of, oftentimes narrow banking is associated with Friedman and the like, and then it gets me thinking, well, but I mean, when we're talking about endogenous money, we often think in terms of the law of the reflux, and you could like distinguish sort of like fiat from like credit money, and credit money is often not assumed to be inflationary. Maybe it is assumed to be like destabilizing because you do get these like asset.
So I think, So I made, so the jump in my mind, at least, and I realize I like skimmed over this in about like 1.5 seconds, but the jump in my mind is, do we want positive rates? Do we want positive nominal rates so we can have a zero real rate or something in that neighborhood? If we do want positive nominal rates, then we need to pay interest on the national debt. And so where I get into narrow banking and those other things, it's a way of paying less interest on the national debt while still maintaining rates. If we want to keep rates pegged at 2% permanent because we think that's where they should be because that's the long run rate of inflation, how can we get them to be 2% without paying 2% interest on the entirety of the national debt? So that's the benefit of narrow banking and these other tactics. It's a way to avoid paying interest if you make the assumption we do need a positive nominal rate.
So the narrow banking was like not to be disinflationary.
It's just to not pay interest on the reserve. So right now there's 14 trillion out there in unreserved deposits. So if we said, hey, banks, you need that 14 trillion, well, then the Fed could go and sell 14 trillion in treasuries just to keep reserves currently where they are. And so we could offset the interest on 14 trillion in treasuries while still maintaining a positive rate. So it's only relevant if you buy the case that, hey, we need a positive nominal rate. But that's why I think it does make sense, if at least worth considering if you do. Patricia.
Just a question on the distortion of asset values. Is that, I'm assuming that that's based on, basically them trying to make a profit from the reserves as sort of buying.
No, this is for individual investors. So this is like coming at it from, people buy bonds all the time based on math that looks a lot like that. Or if you're even buying an investment property, like, hey, I can borrow rates right now at 5%, so a 6% cap rate's good because I'll make a profit. But when you take the yields down to zero, like the math we use to value assets, just doesn't work. And that's where a lot of the confusion on the permanent zero rates comes in for me.
Okay. So can I summarize this as basically saying that we should index savings to inflation? Is that what we're saying?
I think we should. I think that's one aspect of many things. I think there's merit to that for some people. I think for small accounts, I think there's a ton of merit to offering an index product. I don't think we need to for most people. I think if we don't need to pay, if somebody's keeping liquidity, we don't necessarily need to pay them interest on that liquidity. If a large corporation has $10 billion in their treasury account, we don't need to pay them interest on it. They're still going to keep that money there. And so part of what I'm saying is we can maintain rates without paying interest on treasuries and stuff like that. Here.
Could you go a little bit more about why industrial policy as a preemptive move to inflation? Because my understanding is under the industrial policy, usually firms has a tendency to higher their markups.
Well, I'm using that term very loosely. I'm just using it in a way like we should actually think about what the bottlenecks are going to be and address them. We love to do stuff in this country like, let's pay 35% of the cost of all solar panels with no upward price limit, but we'll get rid of it next year. Does that actually address the underlying problem that we don't have enough electricians to install these things? It doesn't. So just making sure we're thinking about what are the constraints that are going to drive prices upward and addressing them first.
Yeah, so this is brilliant because my issue is I'm philosophically against high interest rates because it's a return to capital.
Mm-hmm.
But I'm also concerned about zero interest rates meaning asset types going to infinity. And I think you point out that often the MMT zero ZIRP argument kind of skirts around that. And so, but could it not be the case you can have a zero interest rate policy, but then use credit control to mitigate the policy finance.
Yeah, I definitely think there's potential for that. I do, like there's certain credit controls I think would work really well for that, like financial leverage maybe isn't helpful. Got a margin call on my trading account today with the lovely stock prices, so maybe that wasn't maybe that's not my withdrawals to cover that, maybe isn't just what the market needs today. But I do also worry about some credit controls being more beneficial to inequality. So like when people talk about, well, we need higher down payments, things like that. Well, if we're gonna have super cheap money and high down payments, that's not great. That's great for those with money. It's not great for those without money. So it's not my topic of expertise at all. I do think there's a lot of merit there, but I think just with that caution of just really making sure it's not regressive and how it applies. Here.
Is there like functionally any difference between the Fed's overnight reverse repo program and like the Treasury issuing bonds? Because it sort of seems to me like we're go through this cockamamie scheme of the Fed temporarily will release bonds into the market and buys them back. It's like, why doesn't the Treasury just do it? It just seems.
So I think correct me if I get this wrong, it's not, again, not my expertise, but my understanding of the overnight reverse repos is the Fed's really just borrowing money. They're borrowing money on an overnight basis just to keep it out of the reserves and as a way of maintaining rates. So the GSE, the groups we discussed earlier, the GSEs, the money market funds, and the primary dealers, they don't have access to interest on reserves. So if banks get too greedy arbitraging that, saying, hey, we'll take your money, but we're going to make a big profit for ourselves, that could cause the federal funds rate to go below target. So they're really just trying to extend the subsidy of interest on reserves to people that aren't subject to interest on reserves by letting them, by borrowing from them on an overnight basis. Kennedy.
So I'm just curious if you're, I think I do understand the investment perspective, especially considering we don't live in the job guarantee world and having to entrust to certain.
We don't yet.
I think I said yet, but since we don't live there yet, I can see the aversion to trusting political institutions right now as it exists with certain price controls. So I'm wondering if you envision in a world where there's job guarantee, but also digitized cash throughout globally, and it's also maybe Fed accounts. Do you think that would change your theory a little bit if there's a more a larger social provisioning around investment and the way we do that?
So on the price controls, personally, that's something I'm pretty careful around. I don't see it. Could you convince me of it? Potentially, but it's not where I go initially. I think.
Tell me about price controls. I mean, do you see in a world where we have Fed accounts, digitized cash, and that system, would that change how you look at the nominal rates because the investment class and the people that are able to have access to it might have changed in that period?
I haven't really thought that through, but so I mean, a lot of the stuff kind of looks like could potentially look like narrow banking and get us some of this same direction anyway, is my one thought there, but I'll have to think more on that.
Another naive, perhaps, thing I'm wondering about is, you've used the word investment. Buying bonds isn't investment. It doesn't create productive capacity.
Agreed.
Buying bonds is speculation. We don't call it that in the newspaper in Barron's, but that's what it is. You're trying to get a return, but you haven't created new capacity.
Mm-hmm.
Buying equities is not investing, even though on cable it's not investing, because none of that money goes to the company. They're not gathering capital to create productive capacity. So really what it is the people, I'm trying to put it all together because you're right, that was a lot in 30 minutes. What we're talking about here is the rentier class. Who gives a damn what happens to them?
Well, I think but that is kind of my point of how can we maintain a positive rate without paying just more money to the rentier class. That at the core is what I'm trying to focus on.
How do we maintain a positive rate without just giving more money
to people who already have money? Yes.
Yeah, okay.
Yep, that's the goal. Here.
I have not previously heard the term unreserved deposit, so I didn't understand what you were saying about unreserved deposit tax, UDT.
Yeah, so you haven't previously heard about it because I made it up, so that's why you may be unfamiliar. But the general concept is, try finding that slide. Balance sheet makes it a little easier. So on this sample bank, they have 800 in deposits. So, people have placed $800 with them, and they've loaned out a bunch of that, and so they only have 200 of those deposits left. They've loaned out $600 of the money that was on deposit with them. So the unreserved deposits is the 800 in deposits minus the 200 in reserves. So the general concept, the reason for taking that would be, that way that bank says, hey, and we're going to make yet another loan. So let's imagine this bank loans out another $100, either interbank or to a consumer. Now reserves will fall to 100 from 200, but loans will increase to 800. So the balance sheet remains true there. But now they have 800 deposits and only 100 in reserves. And so that's an extra $100 they're now paying the unreserved deposit tax on. And so that's why the rate would carry through to their lending activity, just as interest on reserves would provide that same disincentive.
So what is the definition of an unreserved deposit?
Simply deposits less reserves.
So it's simply
So if people, in all the deposit...
mathematical difference. But it's,
Yeah. Yep.
But it's not like a category on a balance sheet.
Nope. It's just, taking that 800, subtracting that 200. Taking the deposits, subtracting the reserves, and that gets you the unreserved deposits.
So I'm a little skeptic about the circular logic that represents about the developed countries.
Yeah.
Because you were saying basically that higher rates increase debt service. And that service, to me, you're comparing that service with fiscal policy, active fiscal policy. But they're not the same, they don't have the same effect in the economy. Because that service is more an equal distribution of the money than the fiscal policy, normal fiscal policy with like buying goods and services.
I agree it's very unequal, but it's still more money. It still increases the fiscal deficit.
If you're doing high rates, because the underlying assumption that you were saying to us here is that higher rates doesn't affect the exchange rates. But it's not what happened in the developed nations. You do high rates to control exchange rates. This is what we do since ever.
Yeah. Oh, that's what I'm saying. That's kind of what I'm trying to say here is like the way, like if a currency is weak, there's the incentive to raise rates to strengthen the currency. Do you agree with that part of it?
No, but you were saying that high rates, in the end, by the debt service, would be.
Yeah, I think over time they can create more FX weakness. So if it's likely to greatly increase fiscal deficit. So if the rates increase and now this company is paying out a few percent of GDP on interest, it's increasing the deficit. It's increasing the flows to those foreign bondholders if it is sold to foreign bondholders, and then if they want to redeem their money. I'm not explaining this well, but I believe it to be true. Anyone else want to take a stab for me?
I think what you're trying to say is that if the FX falls, then there's the incentive to raise rates, which creates more income to the private sector, which may further contribute to the FX.
Exactly.
fall.
Listen to her.
I hope that.
Yeah.
Patricia said that this is essentially indexing savings to inflation to ensure, which I interpret as to ensure that the real purchasing power of savers is maintained. Is that accurate?
I'd say that's a very small. I'd say it's I would not say that's accurate, but I'd say that could be part of it. Like that could be for individual savers, but in reality, it's more about just maintaining the rates so they're not negative, I guess is the point there, as opposed to indexing.
Okay.
But it's similar though. I'll have to think on that more.
That undermines my question.
So I assume you picked 2% for inflation because that's like a common number used for everyone. I'm curious
Yeah.
if you have like any opinion on what the target.
I had a slide on this that I deleted right at the last minute. I'm like, why am I having a slide on what the inflation rate should be? That's not my topic. I think 2 is not a bad choice. I think there's a lot of things. I think inflation's important. I think one of the reasons, like from my personal experience, I really love inflation. Like I used to run a big company and we hired a lot of people, and generally the cocky men would come in and they'd make too much money because they interviewed really well. And then the women that would be working next to them would actually be far better employees. But it's hard to give people pay cuts. But it's easy to hold their pay still. And so by having inflation, it made it easier to close that gap. So I think inflation, it helps on that front. I think it helps on kind of forcing amortization of debt. It's a lot harder to lose money on your house if prices are going up by 2% annually, so it really helps there. So I think there's a lot of reasons why inflation's beneficial. I think the downside to inflation, housing becomes unaffordable. If we're basically, if we have 5% inflation, 10% inflation, and that's baked into rates, then if we're forcing you to amortize 5%, 10% of your house every year, that just becomes incredibly unaffordable from a mortgage perspective. So I think it's kind of balancing those drivers, and for me, that gets to something in the 2 to 4% range. Yeah. Your thoughts on that?
No, I was just curious. I'm always curious when someone says 2% if they have some reason for it, or if they're just saying, let's say 2% because everyone else.
There's the really bad reason, which is we need that dry powder for that next recession, because if we actually spent money driving the economy in a way that would help people, that wouldn't be good. So.
Yeah, thank you. Currently, balance sheets and balance sheets are overexposed to grown assets from fossil energies, non-renewable energies. What about the idea of having zero real rates for standard investments and standard bonds, and having negative real rates for green bonds and investment into the ecological transition, especially because usually green bonds have a really smaller leverage effect, so less potential risk.
Yeah, I think there's a lot of merit to that because it does match the long-term disinflationary goal as well. So, yeah, very much agree.
It could be argued that interest rate hikes are super. I don't think it's really arguable. They're super regressive.
I thought you were going to stop at super.
Yeah, because people with less wealth have to the rates are costing them. People with more wealth pay more income. In the U.S., you can actually buy CPI index bonds directly from the Treasury up to $10,000 in face value. Would it make sense to expand programs like that, or perhaps you have a tiered program where
I'm split on that. So on one hand, I do see the merit to having programs like that available to small savers, but not to the wealthy. But at the same time, I'm hesitant to reward the small savers as in contrast to the people with no savings at all. And so if we're going to, introduce more purchasing power, I'd rather do it in a way that hits everyone, not just those that have savings. That said, I do very much think that small savers should be able to save in a way where they're at least keeping pace with inflation. So I do like the CPI indexed ones for that reason.
Oh, and one follow-on, if you don't mind. Would it be correct to think of, because there's a lot of talk about a wealth tax and up 2% rent, would having negative rates for very, very large balances essentially function as a wealth tax?
Well, I'm not sure you can enforce negative rates on very large balances. You can do that in the negative. The money just wouldn't be there if you had negative rates. They just chase yield elsewhere and drive rates everywhere else down as well, I think would be the problem with that. But that's my other thing on why I like a high inflation rate, because it kind of is a tax. It's kind of like a wealth tax. So if we have, 4% inflation, then even if you're just keeping pace, well, your assets are growing by 4% each year. So, if you're paying 20%, 25 basis points on tax on that, that's a percent of your wealth tax effectively. So there's kind of like a stealth wealth tax associated with it, I actually kind of love. So another pro-inflation camp. In the back.
Can you go back to that slide on the long-term and short-term ways of addressing inflation? You know which one I'm talking about?
Yeah. Did I go right by it? Oh, yeah.
Yeah. Okay. So given our preference for using the top panel relative to the bottom panel, should we be targeting any inflation rate at all? And then if not, what implications does that have for your zero real interest rate approach?
Yeah, kind of for the prior question, I think was pretty similar there. I do think a positive inflation rate is powerful. I think it keeps houses from becoming underwater. I think it helps levelize inequalities over time when you have sticky wages. I think it's that stealth wealth tax. So I think there is a lot of merit to having some positive inflation. Because we also live, in communities where, some areas are going up faster than others. So if everything's flat on average, a lot of areas are just going to be becoming depressed. So I think there is that merit to that inflation rate. But I agree, if there was no merit to that, then you wouldn't need any of this.
No, but I'm not saying target 0. I'm saying there shouldn't be one particular number chosen. Maybe we should just say, okay, whatever the result is from employing the top panel as well as possible, that is the inflation rate we have achieved. But that, of course, has implications in terms of what should the central bank policy rate.
Yeah, I think on that topic, like there's so much obsession with inflation when people don't even know. It's like I spent an extra $20 on gas. Oh, by the way, the value of my home went up by like 200 grand last year, but I don't think about that. That's nothing to do with inflation. So I think I think we could message on these things a lot better. I agree that inflation, especially if wages are keeping up, which we could, with the job guarantee help ensure is true. I don't think, inflation is that scary. Of course, I do think, to the earlier point, if inflation gets too high, well then, you can't get, either you have to do deeply negative real rates or just mortgages become unaffordable. So I do think it becomes problematic if you get too high. But I do think we have plenty of tools, especially if we plan in advance and we get some of this stuff in place. Ready for the break?
Thank you very,
Cool.
very much.
Thank you.